The S&P started down last Friday. Today is February 9th. The Super Bowl is tonight. And they're down on Sunday night, as they have been the last 2 weeks before this. We're still bearish. We're expecting the market to decline into late February, potentially potentially about 1/3 of the way through March. And we're not changing any particular viewpoint, except one thing. If the market is down hard the next few days, from the 10th to the 12th or 13th, then that's fine, and we would have been correct about that short term. But if the market goes down, but it doesn't go down a lot, then what? So what we've seen is that there are several different variations of how this can happen. The 147-week cycle, which we've talked about repeatedly, the 162-week cycle, 54 times 3, we've talked about that repeatedly. They're basically bearish into March. And there are highs along the way, which give alternative opportunities to go short. And given the seesaw nature of the market lately, it's not unlikely that if it goes down hard, it's going to shoot back up hard. So, you want to use trailing stops in this situation so that you can keep any profits that you have. Okay, that's one point. The other thing is the monthly cycles, 1 month ago, 2 months ago, 3 months ago, they've been very telling about what's going to happen. Sometimes it goes opposite what happened last month or similar. But they don't all agree exactly on the path forward. What they do agree on is it goes down right away for a few days. And then it's possible we'll see a decent rally after that into the 19th through 26th window. The 19th could be one high. The 26th is potentially another high. And then it should shoot down hard somewhere in February. If it doesn't happen now, it'll happen later in the month. But the idea is to be flexible, to use trailing stops, and to recognize the probabilities are very high it will go down. However, it could still have some rallies in the middle that will shake out the shorts. Okay? All right, that's the added value. Now, I wanted to point out that one of the cycles we're looking at has to do with the nodes of the moon, which is an 18 and a half year interval. It turns out, if you look back to the interaction back in 2005, the patterns in the market are remarkably similar. We found 2 or 3 of them that are that are so similar that I want to show them. One of them is back in 2005. And look how accurately the last 3 months have been repeating. That's 18 and a half years ago. And what it does next, as you can see, it goes down. And it does have one more spike up around the 19th of the month, and then it goes down hard again. So there are several variations of how it'll happen. But the main idea is you want to keep shorting rallies, and you want to keep doing so into early March. It turns out that we've had a lot of people wanting to take our Trade Forecast Mastery course. The last class has been wonderful, and those people are continuing. Looks like we'll probably start another one on March 2nd, Sunday, March 2nd. And if you're interested in doing it, just let us know. You can click on the link below.